Hello friends, good morning. Today we'll be discussing about the budget 2026 and we have with us our strategic advisor Mr. Sunil Subramaniam and Mobina Kapasi. Over to you, Mobina.
Thanks. Thanks, Rajneesh, for that.
Good.
Well, hello, everyone. Budget 2026, and it's more or less left the market quite divided. But one thing is for certain, if we are only expected to judge the reaction to the budget by Sensex and Nifty, well, it's a big thumbs down. At least if the market move is expected to predict or rather denote anything. Well, let's decode exactly the sectors that are affected or remain unaffected, and also what's in store for people like you and me from Budget 2026. Hello, everyone. I'm Mubina Kapasi, and I have with me Sunil Subramaniam, the strategic advisor to iPrudent. Sunil, hi. And I think it's a budget with no surprises. Well, a couple of surprises, but not very, very big as such. I just want to, before we delve into the details, get your initial take on something that stood out for you.
I think what stood out for me was that a lot of good work was done in the budget. It's a pro-economy budget, but I think as in typical, the PR work, a totally unnecessary STT F&O tax came and took away the perception of the budget, especially from market participants. It was, I think, unnecessary, but otherwise, overall, the budget was quite sound given the constraints the finance minister faced.
Let's dive straight into that STT point. But there has been an increase, and you could say that, look, they had to find the revenue from somewhere, right? When GST has been slashed to such an extent and there's so much of excitement in the markets, STT and in fact, in particular, the entire activity of investing and trading is something that has been a target for the FM for the last couple of years, really. So I guess this STT increase may not be that surprising. But I mean, there's also this theory, right? Traders are going to trade. So do you think that we will actually see that decrease perhaps in F&O activity owing to this STT increase?
I'd like to draw a parallel to two things, and I'll answer them as two separate parts. So the first part I want to say is that the trading part of the F&O has been treated like a sin good by the finance minister. So sin good, for example, is cigarettes, let's say, okay, for example. So you keep raising historically, right, excise duty on cigarettes continuously. Why? Because you're confident that it is price inelastic, that how much of you hike it, the smoker is going to smoke, right? And so you keep taxing it, and the government, while it on the surface says that smoking is injurious to health, we are trying to promote good practices in the at the back of their mind, they know that it's a constant source of revenue. So what drives it? Is it that revenue or is it that moral ethical ground? It's always $1 million question. So it's the first part of my answer, right? Now, I'll come now to the second part of my answer. I like to start with a story here. Let's assume that there's a policeman, right? And let's say the police incentives have changed. There's a new police boss who's come in and who says that, look, I want you to be going and working and discovering crimes. So I'm going to give you a bonus every quarter or end of the year, which the number of crimes you have solved, I will give you a proportionate increase in your commission. Now, crimes are bad? Correct. What is the policeman's job? Is it to stop the crimes or not? So when you now come at it, that policeman has got his beat. Once this incentive structure is in place, how does he behave? Does he patrol the street to make sure that thieves don't enter and so that the overall thievery or robbery is come down? Or does he keep quiet and wait for a thief to come and go and catch him so that he gets an incentive bonus? I hope you got the drift of what I'm saying. So coming to the point of F&O, yes, SEBI and everybody else are worried about the retail investor losing money in F&O, have been wanting to do regulation. But the finance minister, by using taxation as an incentive to do this, is, I feel, not right. Because what are you then hoping? You're hoping that the F&O will increase, that this person, like a smoker, he's addicted to F&O option trading, and so here's a nice fat pool of revenue likely to come. And so, but then when you put a public statement, you say that 3 or 4 times the volume of the GDP is in F&O, we want to curb it, hence you're putting this tax. So the question arises, are you doing from the moral ground? Or are you hoping for the revenue fix? I leave the answer to the viewers here, but I think I've made my point very clear.
It's very simple. I mean, whichever way you look at it, whether it's an ethical dilemma that they're trying to solve or the revenue aspect of it, with the government doing something like this, it's a situation of heads I win, tails you lose, honestly. Because whichever way you look at it, whether it's if it's hoping that people will start practicing more prudent financial habits, or whether it is getting more revenue, whichever way, the government still gets to claim a bonus point or a victory point. So I guess that's what it is. But if I want to just speak about mutual funds in particular, there's one category, arbitrage funds, which basically sort of depends on a lot of transactions being conducted so that they can gain from the differentials. How do you see this impact funds like these? Do you see the expenses going up? And do you see it going up to such a manner that, the potential gains from arbitrage funds could be impacted?
Uh, yes, so I do definitely see the cost going up. And what's happened is that the cost will go up for the investor because SEBI recently changed the regulation where they brought, earlier there was a TER concept. Now they have brought it as a base expense ratio, and all taxes and expenses are passed on to the investor over and above the base expense ratio. So this taxation cost will directly go to the investor and impact his returns. But I had a study and a look at a few AMC's arbitrage funds and had a discussion, and I find that it's about 10 basis points on an average that the return will get affected. Now, you look at the history of arbitrage, they have varied between flat to 1% to 7 and 8, depending on the volatility in the market. So in the times when volatility is very high, I think the returns are easy enough to absorb it. But in a time when the market is very flat and not going anywhere, then arbitrage can be very, very marginal. And there at 10 basis points might make a difference because the primary investors in arbitrage funds, because they carry an equity taxation benefit, are institutions and HNI individuals who are using this an alternative to savings bank or liquid funds because there's a better tax arbitrage here. So I think, yes, so it depends on the time frame. Highly volatile markets, these returns, though they won't make much difference, but in a flat market, there could be a significant difference to the investor.
So you think that these funds, even after all of this, still are perhaps a better option than, your savings accounts or your liquid funds to park money, even for retail investors?
Absolutely, because you are going to do a 12.5% long-term capital gains or a 20% short-term capital gains versus 30% which you pay on your savings bank interest. Second aspect is in these funds, only when you pull out the money, you pay a tax. In your savings bank account, every month the interest is taxed. In your FD, even if you don't draw the interest, you're putting a reinvestment fixed deposit, but the accrued interest, you pay tax on it. So there's a postponement of tax element, which is an advantage here, plus the actual taxation being about 20% or 18% lower than normal marginal rate of taxation. So yes, even for tax-paying retail individuals, HNIs and institutions, it still makes sense to invest in arbitrage. Yes, the returns would have come down a bit less compared to before the budget. That's it.
One last question, then we can move on from this topic. How do you see this impact listed names, listed capital market player names?
So it's the same answer that we talked about first, that if you think that the gambler is going to reduce his gambling because the cost of gambling has gone up, no. So I think there will be a knee-jerk reaction in the markets for the capital markets players anticipating a drop in these volumes, but I don't think that it'll set right. And I think any correction is a good time to enter into the capital market space because I think overall in a growing economy with the penetration of equities and mutual funds set to rise, capital market players are going to benefit. So this is a knee-jerk reaction to the thing. I don't think the F&O volumes, they've come down for other reasons, but not because of this.
Fair enough. All right. Okay, FIIs then. I mean, honestly, the reason why we have seen that exit is there are plenty of them. I mean, look at the valuations that Indian markets are commanding. To a certain extent, I truly believe that if a foreign investor is getting these multiples that are in 30s and 40s versus their own home country, which is in single digits, it's obvious that they will consider selling. However, still I would be amiss if I don't ask you this question. Do you think that the government should have done a little bit more to entice FIIs to stay in India? Because at the end of the day, most of these guys are here for the long term. And if our long term story is so promising, then something like valuations shouldn't be a reason why they're exiting. So, do you think that over there the government fell short?
No, I don't think so. I think the government did everything that it could to make FIIs happy. And I'll start off with first and foremost, the fiscal discipline, right? Both in terms of committing to the fiscal deficit and living up to for the current year, and for projecting 10 basis points drop in the fiscal deficit, plus taking on a debt to GDP burden being dropped. I think all those are good news, because ultimately FIs in an emerging country are more worried about risk than about the reward potential. That's number one. So I think the government did it. It's a very good job in terms of maintaining fiscal discipline and the thought process. Number one. Number two, you talked about growth story. The India's valuations are always been at a high level relative to the emerging market, because we are competing for the emerging market pool of FIS. We're not competing with money going back into the developed countries. Remember that. Well, within the emerging markets, we've always carried a premium. It's just that that period amount has come up or come down. And why is that premium being made? It's because of the long-term growth story. Now, what has happened to the long-term growth story? Well, the tariff and the fact that India and US are not on good terms in terms of trade is what has hurt it, because the US is the single largest country in the world, carrying 25 to 28% of the world GDP, with a $19,000 per capita income, had the capacity to absorb all that population-driven strength of manufacturing products at a low price from India. But unless this tariff situation is solved, that future is not looking as bright as it was before this whole thing came thing. So I think it's the Indo-US trade deal which will be a trigger, because India is not traded on PE ratios. It's traded on PEG ratios, which is PEG is taking the growth in the EPS growth. So that's where before September 2024, our story was looking bright and beautiful. After September 24, a number of these events have taken place to say that, are we ready to go into a double-digit GDP growth phase? Before, yes, but now not so sure. So once the US trade deal, and 40% of FIIs are domiciled in the US who come into India. So clearly the US connection is very important, and I think that's far more important. But like I said, when they're entering into a risky space like emerging markets, for them the risk quality, Standard & Poor's upgradation of India was an important step there, but we have to make sure that we are not buying growth at the cost of risk. And that's where the government has done a very good job. So I disagree with the view that's there in the market that the budget has not done enough for FIS. As far as FIS, the rating agencies are an important factor there, and I think they have managed that very well. One more point I want to give here, which is also related to FIS. What do you want for the long-term growth of the country, right? You want the government to give less freebies and invest more on CapEx, which is the multiplier effect. As everybody knows that 1 rupee spent on revenue expenditure goes to half within a period of a year, year and a half. But 1 rupee spent on capex multiplies 4 times over the next 3 to 4 years. So there's a huge future growth multiplier to capex expenditure. Last year, the government took a risk by keeping a flat capex and spending on income tax giveaways and then GST, which worried the FIIs. But now with back again, from last year's actual 10.7 lakh crore, they put 12.2 lakh crores, which is a 12% rise, and not just an 8 to 9% going by just the budget estimate to budget estimate. Go by the actuals, the revised estimates. It's a 12% rise in capital expenditure. So, which is a very good signal as a trigger for the future. And the third point on for the FIs where it's favorable is that India also has been hurt by the fact that we are what was perceived as a hedge to this whole AI boom. But that hedge is not working because AI is still running up. So AI-ready countries like China, Korea, Taiwan, within the emerging market pack are getting a bulk of the flows. And India is perceived to be as not. But this budget has made a significant effort through its data center-related incentives, through its rare earth initiatives and all of that to make a beginning into the AI space. So now the FIs will feel that India is getting its act together on that. And that's a good augur for the future. So once the earnings season and the valuations and everything else comes right and a trade deal gets signed, you'll find FIS coming back. But the budget itself has not done any harm or damage to FIS outlook on India.
Okay, I'll pick up on the vein that you last mentioned, and that's the entire, bit with respect to AIs and the rare earth exploration. There's clarity on taxes, compliances to GCCs, and tax holidays. Do you think now is the time to look at that entire data center value chain in India then?
Well, I would rather play at the second derivative and look at this from the perspective that what is it really going to mean? It's going to mean a huge amount of investment. And I feel that the first thing is the corporate realty sector is going to benefit. So depending on various times, because the actual rare earth and data center will take time to fill out, but the realty is the one which will get an immediate pick. So I'm a big contrarian on the realty part in terms of it's been the worst performing sector last year in the index, but I think the things are falling in place for realty from this whole set of infrastructure play. Is the realty sector which is going to benefit my view. And so it's better to first play that card and then see how the rest of it develops to take incremental exposure into a rare earth play or a data center play itself.
And more doable also, especially for a retail, investor. Just makes much more sense.
If I may just add on the realty part, that apart from this thing, there's another couple of factors which I feel makes reality a good pick. So since we touched on it, I'd like to just cover that. So two things happened here. So one is the pre-budget itself is the fact that the GST cut was seen only in the automobile space. In this summer, it will translate into consumer durables, cooling related durables. But in the later of the year, it's the affordable housing, because the rate cuts from RBI plus the GST cut will make this whole equation around affordable housing much more better. The problem there was lack of supply, because builders didn't have the confidence they could sell affordable homes, so they focused on the premium homes. But now this flowing through, I believe by the second half, you will have enough supply of affordable homes coming, and the EMI impact of even a small cut in interest rate on the EMI is huge in a 20-year loan. So I believe that affordable housing is a big story. Will take a bit more time, but will play out in the medium term. That's number one. Number two is the taxation around the REITs. It's been made into equity taxation. So now the whole corporate realty world has got another source of financing from mutual funds. And equity as an asset class is what, 50 lakh crore in India in the mutual fund. Even a 1% additional allocation to it will make financing much more cheaper compared to what they go and borrow out in the market. The third part is from the budget, is this PSU REITs, which they have now permitted for the PSU land banks to be floated as REITs. That means the liquidity in the REIT into the supply paper is going to go up. So that's going to be a very good financing option in the coming times. So I feel that realty has multiple things going for it in a medium-term perspective.
Very interesting. Very good points, in fact. Yeah. So CapEx story, excellent. That multiplier effect is going to kick in. Defense outlay is also amazing. I mean, there's, I think, been a 7 to 8% increase compared to, what was budgeted. How do you see this trickle down into the listed space?
I'm not very confident on that, because I think the market itself is also expecting much more, though it's actually significant, much more. That is one part. But the second part, I'll tell you two things to it. One is that even within the defense budget, a huge amount goes into salaries and one rank, one pension, OROP, and those kind of things. So while it's classified as defense, it's not truly capex. That's number one. Number two is a lot of India's defense expenditure, the big ticket one, is on imports. It's on buying the Rafale jets. It's on buying stuff from Russia. So how much of that will come into domestic companies? I know Rafale, there is an indigenization plan, the 30 to 40% they will produce, but overall in the making. So I'm not so sure that this budget has done enough, though it's been the single largest, to make domestic defense suddenly. Domestic defense has its own drivers, but they're not budget related. They are related to NATO and the US withdrawing from NATO, and hence individual European countries needing to build their own arms stockpile. And India, having shown its drones and UAV capability in the Indo-Pak war, is now ideally positioned to be supplying those modern technological warfare to that. That's a different thing, but it's not related to the budget. So the budget itself, I think that though the allocation was significant, I think that it's not really going to translate so much in terms of domestic defense companies.
All right. So right now, you think real estate is that one sector that's going to come out as the biggest beneficiary as opposed to any other sector?
Not just opposed to the other sector, which I believe its budget is given a good signal to invest in, is consumption. And the reason I say that is this: most of the budget, and one of the reasons that the market also didn't take kindly to it on the day, though today it's the day after it's doing better, is the fact that a lot of the budgetary incentives are for non-stock market participants in the fields of agri, in the fields of MSME, for example. Now, MSME is what, 40% of the country's GDP. largest employment generator, and they have focused a lot of energy. They put a special fund for MSMEs of 10,000 crores and all of that. So that's not directly related to stock market, but what that's going to do is it's going to boost first our export story, because of MSMEs are one of the biggest exporters in terms of total value. Second is they are the biggest employment generator. So this boost to the MSME over the medium term, when it plays out, will mean more jobs, will mean more salaries, will mean more consumption. So as a second order impact, this all is going to come and boost the consumption story in the medium term. So I believe that the real takeaway from the budget to me is that the government is doing enough to spread the GDP growth across a vast section and not just limited to the stock market constituents. And hence, consumption is the way it will come back to play in the stock market, and with a delayed impact on private sector capacity creation. Because when consumption goes up, capacity utilization goes up, and private capex also gets a trigger. But that's again a little bit later.
What do you think of this entire committee that's been formed to prep the financial sector also for Viksit Bharat 2047? I mean, it's very futuristic, of course, but if I had to just, take your opinion, I mean, you've been in the financial sector for many years. What do you think is needed as a boost to the sector for the ambitions that India has for the next 25 years?
So the finance minister didn't say it, but the real purpose of this whole exercise is to merge the medium-sized public sector banks and leave only 3 or 4 large global scale rank 50 to 100 banks, so that they can tap long-term foreign capital either as dollar loans or as masala bonds in rupee terms to finance the project finance, because we no longer have those project financing institutions like ICICI Limited. So PSU banks have to take the burden of financing the private sector capex, infrastructure, and everything. So they need long-term financing at competitive rates. For that, they need to have global scale. So I think the budget, short of announcing that, I read this as build scale for Indian financial institutions. And so public sector mergers, I believe, in the next few months will be what this committee will come up and recommend and implement. I think it was a hot potato for them to announce it in the budget. So they found this euphemistic way of handling it, is my perception of this whole thing. So I view that as, again, a huge positive for public sector banks.
Okay, well, all right. Kicking the can down the road, I guess, in a certain extent. Maybe we'll see it in a couple of budgets down the line. All right. Well, I want to move away from sectors and talk to you about something that's very controversial. What's your take on the kicker that FM has announced on sovereign gold bonds? Again, we more than enough has been spoken about the gold rally, and mainly when people bought SGBs in the secondary market, it was to enjoy the whole tax benefit that you get, right? Interest and during redemption, so on and so forth. And now suddenly this kicker of sorts has come in. I just wanted to get your opinion on it.
Two things on it. I think it's the right thing, but I think what's wrong is the retrospective thing. Okay. So let me tell you why I feel is the right thing. See, why did government bring sovereign gold bonds? It was not to give people a chance to buy an unproductive asset in the country. Let's take away that notion. Government is not interested in people storing more and more gold. It's an unprotected asset, get locked in lockers. Instead of that, you are now saying do it as financially. No, the purpose was with the whatever they were giving, like 2% interest rate. And in those days, when they started it 7, 8 years ago, there was no thing that the gold prices are going to rocket like this. So government got caught on the wrong foot. They thought gold is a reasonably stable asset class. And they said, I am able to raise 6, 7 year funding at 2% cost. And I have enough gold reserves in my thing to meet these when they redeem. So the government's purpose was that compared to 6.5% treasury borrowing rate, I'm borrowing at 2% and I already have the gold to hedge it. So I'm not really exposed. That's what the purpose of it was. And for people, it made sense because on an idle asset, you're getting a 2% return. It's taxable, but it was capital gains tax free. So it's gave a huge incentive and hence there was a rush towards it. The government got caught on the wrong foot with a rapid rise in the gold price. Hence they stopped this. Now, the purpose of the government was to get that money for itself. Now, by allowing people to trade in it, they should have made this instrument non-tradable. By allowing it to trade, what is the government got a benefit? Different people have booked profits at different times and taking it out. That's just part of market action. What does it benefit the government? What is the purpose of this? So that action, they should have put this in the first itself that only the person holding till maturity should have got it. It was a mistake on their part. They missed it out. They didn't realize this would become a hugely traded asset. And hence they are now closing the door. But like I said, It's the right thing because the guy who first gave the money helped the government by helping them borrow at that low single digit rate of interest and help them. So he deserved that tax break or whatever to capital gains. But for somebody else coming and trading, why are you just creating an instrument based on an asset which is unproductive? But when they introduced this rule, they should have made it prospective. What is not right is that somebody who took the facts on hand and said there is capital gains and paid a price for it. Now you told him that that price was wrong, and the guy who sold it walked away happy all the way at the bank. I think that retrospective element of it, if it can be corrected in the post budget, I would be happy if it is done because it leaves a very, very bad and wrong taste in people's mouths and it's not right. Nothing retrospective is right. You take decisions based on the decisions at hand, and you don't want the government to come and say, then you're going to second guess the government every time you take a decision on an investment. So it shouldn't be that. That's the credibility of the government will be at stake. So I would like the retrospective part, which is trades starting from now on in SGBs should not be allowed capital gain. But somebody has already bought it in the secondary market. The price carried that weight in it. And he paid that price and got a discount or whatever you call it. So I think that's my view on this matter.
I mean, they've not come out with a primary issue in I don't know how many years. So naturally, there was a lot of activity happening in the secondary market for SGBs. And yeah, you're spot on. Retrospective taxation has been that one evil, if you could call it that, in the market circles and for investors as well. So yeah, I think fair point. Prospectively still would have helped people also make the right decisions considering they have full information. Buyback now to be treated as capital gains, much more lucrative. And I think everybody's sort of trying to remember episodes like, for example, Tata Motors, the most notorious one, I guess, in the last 1-2 years. So, yeah, your thoughts. Do you think it's coming a bit too late, though?
I think it's coming a bit too late, but I think it's a great thing. But not only for the investor, it's great to have an efficient form of taxation. But the point is that at the corporate level, they're putting a penalty. I like that too. Because tell me, buybacks itself are just another form of dividend, right? So when you're doing a buyback as a corporate, what are you saying? I'm giving money back to my investor, right? But the reason you're doing it this way is because you feel your share is undervalued and you're trying to shore it up by doing this, number one. Number two, you're giving a signal that my business doesn't have any opportunity to use my cash. Here, take it back. So you're conveying a very wrong signal about your own business. So I think that this will now force corporates to think twice and say, oh, if the next 2 years I see a plan for capacity, rather than now give a buyback and go for a fresh equity issuance to finance that, let me keep it and deploy it. So I think that will help the capex cycle in a way, because people will be now placing a greater premium on reinvesting in their business, which is what ultimately that shareholder wants, and not just give the money back to me because I don't know what to do with it and I don't have an adequate return and I'm only putting it in a mutual fund, liquid fund, and delivering suboptimal returns. Instead, you take the money. So I think that conceptually, right, I'm in favor of this tax, and to the investor, because he is taking this in a suboptimal decision-making process, he is now benefiting from a fact that, oh, I got my money back, but at least I got capital gains tax. So I think a very good decision on all fronts, and I welcome this. Though you're right that it's probably a bit late in the day.
Do you think, the one thing that's been looming large for everybody is obviously US tariffs. I know we mentioned it a little bit earlier. And many say it's also one of the key reasons why the Indian markets have also been falling, apart from other reasons. Would you have liked to see perhaps some sort of preventive measures, maybe something for those export sensitive sectors? I myself have spoken to so many businesses where they say that our stock is literally just lying at ports. It has been stopped because of the tariffs. Do you think something could have been done to those kind of sectors which are very sensitive to US tariffs and things like that? And we're very exposed to it at this point. It's been 1 year, no deal has been signed yet. Do you think something could have been done there?
I don't think so, because I think that the budget is not a place to deal with tactical things, number one, because you are laying a long-term strategy, you're committing to that, and you're saying, this is my way I go forward and do. And you say, oh, now there is a tariff. And 1 month later, tariff gets solved. Will you roll back all those better decisions to support exporters? That's a very mishap way of handling that, shoddy way of handling. I don't think the budget is meant to tackle things like currency movement, for example. Another question which was asked was, "Who is the budget going to help the currency not depreciate?" No, that's not the budget's task. The budget's task is to lay down a long-term plan for growth, how you're financing the growth, and how you're reducing your dependence on borrowings and increasing the revenue of the country. That's it. Within that, you choose the sectors to do what you want to do. But a short-term tactical defense against this, which could get solved anytime now, is one. Second is, it's not that the government is not confident of solving it. It's just there are red lines in terms of agri and dairy on which we don't want to give up, and which will be political suicide if anybody actually gives up something there. So I think that that's the reason the delay in the whole deal. But it's like it's always around the corner. Every time you get either Mr. Anantha Nageswaran or Mr. Piyush Goyal or Mr. Jaishankar speak about it, they say things are proceeding well, talks are well, it's around the corner, it's around the corner. Thing is that corner is not coming. But it's only a matter of time, because India has done enough to tell the US that, hey, we are not dependent on you. So the government is acting on this tariff situation by building a multi-pronged approach. So they're not, you can't accuse them of saying they are not doing anything about it. They are helping the exporters to find newer markets by signing newer deals, number one. Number two, between the government and the RBI, I'm sure there have been back-end talks by which the rupee has been allowed to weaken to support the exporters. So that again is a non-budget way where they've handled it. The dollar has weakened 9% DXY in 1 year, and the rupee has weakened 7 or 8%. So which is very contrarian, right? When a dollar weakens, rupee should strengthen. And that's a double whammy. And that's happened. Yes, FII flows have contributed, outflows have contributed, but the RBI has used only 10% of its reserves to defend the rupee, about 60 billion out of these total 700 billion. So they could have used another 10% to defend it, but they have tactically not done it. A, because they don't target a price, but B, because silently currency weakening is one of the biggest defenses against the tariff. And it's a permanent weakening, because if you look at it, unless FI flows come back in the dham way, rupee is going to be stable around these, and only the level of depreciation is important. But tomorrow when the tariffs get rolled back, we have already got a benefit in terms of depreciation plus a lower tariff in the future. It's a fantastic thing, right? So I think that that's being separately handled by the trade team and the Reserve Bank in terms of helping exporters on the tariff front. I don't think the budget was the time and the place where this should have been addressed for what is, really speaking, a fairly short term. Yeah, I don't think that you're going to say, oh, for the next 3 years, we're going to have this 50% tariffs, right? We all know that both teams are working hard at it. It's a matter of time before it gets solved.
Yeah, I mean, there's no doubt the RBI has done a fantastic job that way in ensuring that the rupee is depreciating, but in a calibrated manner. I mean, you see what has happened to other EMs comparatively, and you just look at the last 3 years. Yes, there has obviously been a depreciation in the rupee, but compared to, let's say, what's happened in the rand or the real, it's just been a bit more moderate and not that volatile. So that goes without saying. And any which ways, let's leave the currency to the currency masters and let the FM continue doing what she's doing. But yeah, you raised a very fair point that this is not for tactical measures or to assuage certain political whimsies. That's for sure. All right. Well, final question then, Mr. Subramaniam, from my side. Overall, if you had to rate the budget, a favorite question, how would you rate it?
Well, normally they say there's a median and an average, right? And
Yeah.
the average is determined by people who give very low ratings and very high. I'm on the
Yeah.
very high side. I rated it a 7 on a 10 when it came out, and I stick to that.
All right. Well, I gauge that. I mean, you definitely had a lot of positive to say, and it's always wonderful to listen to every kind of opinion out there. So, thank you so much, Mr. Subramaniam, for joining us. And for all of you folks, I hope this has simplified the budget for you, told you exactly the good, the bad, the ugly of it, and of course, how you should be reading into all of the jargons that are often thrown at you. That's it from all of us right here at iPrudent. Thank you so much for watching.
Right. Thanks, Movina. Thanks.